Folks, if we've learned anything in the past several months, it's that accepting a single number at face value is a terrible strategy for your long term financial health. Markets twitch on releases. You see a headline and your finger starts to itch for the buy or sell button. Economists expect X, the print is X plus epsilon, and the tape undulates like a seasick sailor. Why does that first jolt even happen? Well, it's not that smart people are scrambling. It's the algo desks. Machines read the news ticker, pounce for a tiny edge, size it with big capital, and exit before you finish your first sip of coffee. Trust me, they are not buying for the long haul. They are renting momentum for just seconds or even milliseconds. Who fills your reactive order? Well, the same algo that just took profits and handed you the bag. Now, I'm not telling you that numbers don't matter. I am telling you, however, that if they signal real change, your edge is not in the first minute. If a print genuinely alters the path of growth, inflation, or policy, well, your decision will still be valid at lunch, at the close, or even tomorrow. Impulse trades feed machines. Deliberate trades feed your returns. Remember that. You're going to find that on a t-shirt someday soon. Why bring this up today? Because markets have been dancing to the rhythm of bond yields, and bond yields have been dancing to the Fed. The Fed cares about the labor market and inflation, full stop. We just learned the labor market is softer than we thought. Revisions and weak prints have raised the odds of rate cuts, and its counterweight is the old foe, sticky inflation. The Fed's self-imposed 2% target is the North Star. If the city basket rises more than 2% year over year, the Fed tightens to cool demand. If it rises less, the Fed loosens to support demand. Raise rates, financing gets costlier. Big ticket demand cools, and prices should follow. Cut rates, credit cheapens, demand lifts, pricing power improves. That is like textbook economics. But what if the problem is not demand? What if suppliers and structure are driving prices, not shoppers? This is where today's CPI matters, and where most people stop at the headline and miss the real story. Last month, headline momentum eased, but services inflation nudged higher, and that sparked a little bit of hand-wringing. Goods inflation has been quiet since late 2022, even negative in certain places. Service inflation, on the other hand, has been sticky, like a piece of gum on your shoe that just won't let go. When you pull the CPI apart, core services is boss level. Zoom in on core services year over year. Pre-pandemic, it hugged around 3%. Then it cratered through the lockdowns. Then it surged into early 2023 as the economy reopened. Ultimately, it cooled as the hikes bit. And since April, it has bent up a little bit again. That bend is what the Fed is staring at, not your favorite meme stock, trust me. Now, look at the bars beneath the white line. Shelter is the elephant, roughly 60% of core services. Call it rent and the peculiar owner equivalent rent, aka the cost of a roof over your head. Shelter ran just over 3% before the pandemic, and it's still above that. But the trend has been drifting lower, albeit slowly, glacially, but lower all the same. Then comes transportation services. That's the mustard bar, and it's just not quitting. That category was hot, it cooled, and it's edging up again. Why? Because nearly half of it is vehicle insurance and a chunk of vehicle maintenance. Look, no one is shopping for fun here. This is like mandatory life stuff. Medical services is the purple bar, and you just can't ignore that. It spiked during the pandemic, spiked again post-pandemic as delayed procedures came back. Then it faded into early 2024 and has ticked up again. Inside that, well, health insurance went deflationary in 2023 due to methodology quirks, then reinflated in mid-2024. Professional services has crawled higher for years and recently perked up. Put this together, the sticky part of CPI is largely services. Within services, their acceleration has been driven by transportation services and medical services, largely vehicle insurance and health insurance, with a side of maintenance and professional care. What do these have in common? Well, they're both not about shopper fervor. They're about requirements, regulations in some cases, claims experience, input costs, and capacity. This matters because the Fed's toolkit is demand side. You hike to deter marginal buyers of cars, furniture, vacations, but you can't opt out of car insurance. It's required by the law. You can't completely opt out of health insurance. It's kind of like required for life. Those demand curves are nearly vertical, highly inelastic to use econ talk. You can nudge at the edges, but rate policy does not turn mandates into optionals. Meanwhile, shelter is drifting lower, and here's the twist the talking heads are all avoiding. High rates choke housing supply. They keep owners locked into old mortgages. They deter new construction finance. They tighten multifamily pipelines. That tends to prop shelter costs up, not lower them. Cuts over time could actually ease shelter by unlocking supply, the opposite of good dynamics. So, when the tape jerks on CPI day, ask yourself what actually moved. If the uptick is insurance heavy, that's not a green light for more hikes. It's a reminder that policy has blind spots. If shelter cools faster, that's the quiet disinflation you will not see in the first 5 minutes of trade. Machines trade the print, investors trade the mosaic. Tariffs. Everyone wants to blame or credit tariffs. If you want to see tariff effects, look at core goods. That is where cost push from supply chains show up first. So far, it's been kind of muted with pockets of life. This morning's release showed a continuation of that slow growing trend, which was unfortunately led by autos and apparel, both likely caused by tariffs. Services came in a little bit more muted after last month's acceleration, driven by mainly, again, auto and health insurance. Those, unfortunately, cannot be tamed with Fed policy, nor can tariff driven goods inflation. Back to the labor market, because this loops through policy. Weakening jobs data raises the odds of cuts, but affirming services CPI makes the Fed nervous. That is the tug of war. Taking apart the CPI basket tells you which team is winning this week and which argument the committee will favor in their statement. You don't need the first print to see that. You just need the breakdown. So, what should you do as an investor? Well, first, stop chasing the first move. And second, focus on the composition, not just the top line. Third, map each component to its economic driver: shelter, supply and financial conditions, transportation services, insurance claims, parts, labor, regulation, medical services, insurance pricing, utilization, provider cost, pharma inputs. Fourth, ask whether the Fed's tool can touch that driver. Now, a word of healthcare costs, because this one gets a little bit misunderstood. The single largest contributor to health insurance costs is pharmaceutical spend, directly and indirectly, through drug pricing, specialty therapies, and rebate dynamics that flow through premiums. When that line runs, it drags insurance with it, which drags medical service, which drags core services, which drags the whole CPI debate. This is why I tell you to do your homework. Follow the inputs, not just the index. Let's tie the bow. Algo traders will trade the surprise. You will be tempted to follow, and the print will look like it deserves a trophy. But the real edge is in knowing whether the surprise is about elastic demand that policy can tame, or about inelastic obligations that policy barely touches. If it's the latter, don't expect the Fed to magic wand your car insurance bill. If it's the former, then yes, policy can lean on it a bit. Either way, your best trade is patient, evidence-driven, and composed. All right, one last reminder before you head to the open. Shelter inflation is slowing, even if it's painfully slow. Transportation services and medical services are the new heat. Tariffs belong in core goods, not your dentist bill. And on days like today, the people who win are the ones who read the bars, not just the line. So here's your truth bomb for today. Sticky CPI is mostly a services story, and the chunk that's rising is inelastic insurance cost that rate hikes cannot fix. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.